Today's video is on the ugly truth about the foreclosure crisis, or is it really the unaffordability payment delinquency crisis? And today I have Melody Wright with us today to help us try to figure out why an additional 404,000 homeowners are now behind on their mortgage. And Melody Wright, it's always a pleasure to share the screen with you. And guys, don't forget, if you like what she has to say, go to her channel. I'll show them that in a minute. And Melody, can you just tell the viewers, any new viewers especially that don't know who you are, why it is that we're talking, and rather, what's your background and expertise when it comes to all things mortgage and foreclosure and delinquency?
Sure. And so I'll make this quick, Travis, for those that already know who I am. But I fell into mortgage in 2006, right before everything went haywire. I was on the forefront because my company had just completed, they were acquired by a private equity firm. That private equity firm called Cerberus wanted a purchase price adjustment because they realized that we had just reached the top of the housing market and things were not looking so rosy. And so we led the write-downs that you would later see by the big banks. And so I probably had about 1 or 2 normal months in my new job, and then everything went absolutely bananas. And that continued all the way through to 2014, quite honestly. But while I was at that company, I started in corporate finance. So I was over both origination and servicing of mortgages, but then and also helped with our bankruptcy when we ultimately filed in 2012. I also helped with the consent orders and AG settlement. What those were was all of that regulatory trouble the mortgage servicers got in around the default crisis. But once that was kind of buttoned up, I went on to manage default at my company, and we were a top 5 originator and servicer. At the time, I oversaw over 65,000 foreclosures. This was in 2012. And so, a lot of people think that the GFC or the mortgage crisis happened. They talk about 2008, but in reality, it really went on for a very long time, really through all the way up to 2015. But what ultimately saved the mortgage industry was Wall Street coming in and buying properties at scale. Kind of from there, I went off to other non-bank originators and servicers, trying to get them up to speed with the new Dodd-Frank legislation. And that really kind of brought me back to some of my technology background and trying to create technology in fintech companies for the industry. I then started diving back into macro in 2021 because everyone around me was asking, when are rates going to rise? Because that would have obviously put the brakes on what was a crazy origination market. And from there, I ended up on the road in 2023 because I could not understand what anybody was saying about the housing market with with my expertise, my background, what I knew about demographics, what I knew about macroeconomics. I could not, for the life of me, understand what people were talking about when they talked about an inventory shortage. And so I hit the road in early 2023, going out to Texas, Nashville, Florida, Charlotte, all over the country, and could see that we did not have an inventory shortage. And then fast forward to January 24, you and I went on the road in an ice storm, very similar to what it looks like outside my window right now. We crossed a mountain pass in Asheville on ice in your truck. And we did a trip up the East Coast. We've since done several trips to go out there and really show everybody all of that excess inventory that is out there. So that's just a quick, anything you want me to add on that, Travis?
No, I'll say that. In other words, y'all, she is well cultured in the mortgage and foreclosure department. And one thing that I really love about Melody and how I really think she complements what I've been doing in just the channel overall is she has a ton of insights and expertise behind the scenes. I mean, think about what she's just said. She managed, just one person, 65,000 delinquencies or foreclosures for just one bank. My point in saying this is we have the right person on today to help figure out what's going on. Now, what I want to do, Melody, is for the viewers, I want to quickly go through the updated HUD monthly foreclosure statement. And then obviously I want to get back to your expertise. Again, ultimately, what it's going to show is there's a total of 10.7 million people right now that are either behind on their mortgage or behind on their rent. And as far as just mortgage, in just 1 month, 404,000 more people stop paying their mortgage. As always, this will be linked in the description. Also in the description is all of Melody Wright's information if you want to subscribe to her Substack and just watch her on YouTube. Now this is the housing market indicator monthly report. You guys can see here, this is for December 2024. This is from HUD, the housing market fact sheet. And there's a few things I want to point out that I think are important for everyone to understand if you want to know what's happening in the housing market, especially with foreclosures. Now, the name of the game is essentially, like we've been talking about for like 4 years, affordability. And so I want to take you guys to the second row here, which is home ownership affordability index. And what I want to do is compare the column highlighted in gold. We're going to compare against the column right here, okay, that my mouse is over, which is year over year data. So the first thing is homeownership affordability has gotten worse and gone to 102.3. 1 year ago, it was at 89.9. So the first thing is, again, guys, affordability is worse than it was last year. Even though this is saying the average interest rate is 6.85, as of today, or the making of this video, interest rates are in the 7s. Housing supply has been going up. If you guys look right here, just looking at new homes, the new home inventory is saying right now there's 490,000 new homes for sale. I could tell you guys, and Melody could tell you it's more than that, but that gives us 8.9 months of inventory or supply right now. That's insane. Now, the good news is we've been watching existing homes. Existing home inventory has gone up to 1.33 million, giving us total months of supply right now of 3.8 months, which is roughly about what we were at in 2017. Now, when I scroll down here to FHA mortgage originations, another important thing I want you guys to understand is, yes, people are maxed out. Unaffordability is crazy, but there are still several million homeowners that have equity that they want to cash out on to try to stop the bleeding. And we see that when we look at FHA mortgage originations. Refinance originations accounted for 22% of the business. That's up from 13% last year. So what I'm saying is, first of all, why would you want to refinance right now? Interest rates are super high. They're 6 and 7%. So if you're refinancing right now, it's because you have to. Why do you have to? Because you need the money to survive. When we look at the mortgage delinquency rates, and this is just for FHA, and really think about this, the delinquency rate on FHA is 12.6%. 12.6%. 12.6%. Now that is up from 11% year over year. So again, the trajectory is going up. Rental households and households with mortgages. Starting with the rental households, right now, 12.8%. I'm going to say it again. 12.8% of rental households are behind on their rent. That is up from 12.1% year over year. Now take a look at homeowners' ability to pay their mortgage. That is now at 5.9%. That went up from 5.2% a year ago and from 5.41% just 1 month ago. And I'm going to show you guys the math. The bucket of estimates for rental households is 45.99 million. For mortgages, you see right here, it's 82.5 million. That bucket is way more than Black Knight, who gives us overly optimistic data. But I do want to point out that Pulse surveys have almost double that amount, sitting at 150 million. But nevertheless, this is still more than Black Knight. Wanted to make that clear. Starting with the rental households, when again, we take the 45.99 million and we multiply that by the 12.8%, that gives us a total amount of 5.88 million households behind. Now, last month it was 5.65 million, giving us a total of 229,000 more renters that are behind on their rent. When we go down here to mortgages, we take 82.5 million, multiply it by that, gives us 4.86 million households behind on their mortgage. And remember, they're not even looking at all of the data. When we look at last month, it was at 4.46 million. So that has gone up 404,000 in just 1 month. When we add everything together, you guys, this gives us 10.7 million households that are behind on either their mortgage or their rent. And when we look at just the 1 month increase, 634,000 more households have stopped paying their house payments. So to me, Melody, it's a clear sign of unaffordability. It's a clear sign of those things. But I want to go back to you now. And based on your insights, based on your expertise, what do you see happening right now? And what do you see happening going into 2025?
Yeah, so Travis, we saw a big jump in delinquency in June, and I think I came on your channel and talked about it then. I also talked about the push and pull of delinquency, as there are so many workouts out there that these borrowers could qualify for. But what we wanted to look at is the 90 plus and 120 plus days of delinquency increasing? Because if that starts to increase materially, we know that those folks are not being saved by the workouts, because the servicers are incentivized to do very early intervention. On day 36 of that delinquency, they have to make calls, they have to send letters, they have to do all kinds of things, because the agencies have done research and know that if you get in early, it's more likely you're going to save those borrowers. So when you start to see that 90 and 120 day delinquency increase, that's when you know that you're getting build up behind that workout dam that is threatening to kind of break through. And that's exactly what we're saying. So I'm just going to list a couple numbers. Year over year, we've seen 90-day delinquency increase 23.76%. And this is using Black Knight data.
Okay.
We've seen 120-day delinquency increase 11.78%. Month over month, we saw an overall delinquency, including foreclosure, increase by 6.88%. Now, you and I have been studying this data for years, right, Travis? And we know that typically we have not seen more than a few basis points of increase in month over month delinquency, except for that outlier in June. And so what you're starting to see is that people are getting to the point that they simply cannot afford their mortgages, as well as we're starting to see those who maybe got their workouts already. Because remember, we just went through GFC style, actually on steroids, intervention, government intervention with the COVID forbearance, the payment deferrals, the partial claim when it comes to FHA. And so in reality, we should be seeing zero delinquency, or very, very little, at a 4.1% unemployment rate. But that's not, and after the government intervened to such a degree, but that's not what we're seeing. And so now delinquency is somewhat seasonal. It always does kind of accelerate right as you get to the holidays, because people's go out and overspend, as you and I well know, and they're just trying to make do so they can get those presents under the tree. And so some of them make the difficult decision to pay their mortgage late. But last year, what you would typically see in the spring is a catch up of that delinquency. We did not see that last year. And so basically what you've had starting in June 2023 is when we saw that first, what I like to call the death cross. That was FHA 30-day delinquency started accelerating. That was our first cohort. We had our second cohort in June of this year. And honestly, I think what we will likely start to see probably about the third or fourth month of next year is we're going to see more of those Fannie and Freddie borrowers join the party. Because right now, the delinquency is primarily in the FHA, VA, as well as in the private loans. Now, all of those together are 25% of the mortgage market, and 25% of the mortgage market is already over 8% delinquent. And so those numbers are concerning, because honestly, if you think about that, these are people that cannot contribute to consumption or to our GDP, which is 70% consumption, because they do not have the purchasing power anymore. Their credit scores have been impacted. And so, the picture is looking more and more dire.
And Melody, I I think we've painted a clear picture to the viewers. Foreclosures generally happen after a recession has started because it really accompanies job loss. So can I, get your opinion on what do you think the biggest factor is? I mean, you said unaffordability, right? So affordability would be the answer on the biggest factor driving late payments. But why do you think affordability became the biggest factor driving these payment defaults?
Well, I think we've seen accelerating layoffs, bankruptcies. But also I just don't believe proper consideration was given to debt to income. I think we left the GFC thinking we were paying more attention to credit quality, but as you and I often talk about, that never really, the GSCs or the government sponsored enterprises always had a pass, and they took the debt to income ratios out of that legislation. And so, actually, my colleague, Mr. Awesome, and I were doing an analysis earlier this week. We were looking at the FHFA, which is who oversees Fannie and Freddie, and looking at debt to income, and we are right at the same percentage as we were before the GFC, and it's increased. And so, I believe yet again, we essentially went out and tried to give anybody a mortgage who wanted one, unfortunately. And we had inflated credit scores. And we just don't have the wage growth or the jobs to sustain this. And so many of these folks have gotten laid off or had their hours reduced and have had to try to get a second job or go into the gig economy, which is just not covering the bills as inflation persists, as those costs are still, very high, eggs, et cetera, the basic things you need to live life. And so people are just stretched way too thin. Additionally, Travis, over the holiday, I had several people contact me regarding defaulted loans and help that they needed. And as I looked at those title reports, Travis, when do you think those loans were originated?
I'm going to say 2021 or 2022.
2005 and 6.
That's interesting.
Because, and I'm sorry, that is a trick question because you and I often look at the early stage delinquency in that
Yeah.
2021 origination vintage. But this is the thing, guys. We never fully resolved the
Oh,
GFC. We never did. And so people that became heavily leveraged in 2005 with those adjustable rate mortgages or interest only loans, things like that, they modified their way out and they have been extending and pretending since really 2010, and now they're redefaulting because the jig is up. It's musical chairs, and the chair has been pulled back, and there's nowhere to go. And so I think that's actually what we're going to see. Is not only are we going to see these, more recent vintages, which are going delinquent at an accelerated pace, we're also going to see the play out from the last crisis.
yeah. I mean, and then, I think another factor as well, as far as the affordability for houses, is the Federal Reserve and their fraud, greed, corruption, as well from the CEOs, Fannie Mae, Freddie Mac. We'll get into all that. Now, I kind of look at payment defaults as a new NOD. So I wanted to get into that. But let me ask you this question before we go into the next segment of this video, which is going to go into like debt to income ratio, early stage defaults. Can you explain, Melody, again, your background expertise is so perfect for this question, but obviously things have been unaffordable for a while. Not even arguably, mathematically, things have been more unaffordable than the global financial crisis of 2008. So things are more unaffordable right now, but prices haven't gone down overall nearly as much as the GFC yet. So can you explain how the current banking dynamics has actually kept this party going?
Yeah, I just think the bank rescues in 2023 gave everybody a hall pass to just keep speculating, keep, you know, taking risky bets. And so it sustained, we were able to sustain the narrative through 23. And then 2024 became about the election. And come hell or high water, no one was going, because both parties really didn't want to kind of admit where the economy was. And so, come hell or high water, we could not face reality in 2024. And now 2025 is going to be very interesting because you have an administration that probably knows it needs to just get this out of the way. You've seen Trump going out in the press talking about a 1929, in style depression, and perhaps he's front running. He's so uh, he changes his mind a little bit. So I'm not exactly sure, what the plan is going to be day one. But we just had a very strong jobs report, and there are people now talking about rates, about the Fed raising rates versus lowering them. So 2025, from a narrative perspective, is going to be very interesting. But the fundamentals do not lie, and people simply cannot afford to service their debt.
Yeah, I mean, that's absolutely right. So let's go into that part of this video now. Let me show the viewers a few data sets that are important to understand how bad the housing market really is if you buy a house right now. Taking a look at the U.S. Department of Housing and Urban Development, this is the debt to income ratio. And I just want to read this first part, Melody, because it's not supposed to be like this. Approximately 31% of all FHA insured purchase endorsements in the fourth quarter of 2024 had debt to income ratios over 50%, 31%. And the reason why I think this is so alarming is they're using gross income. So half of someone's gross income can go towards qualifying for a loan. But everyone knows we don't take home gross income. Taxes are taken out, 401k, medical, whatever it is, you got to use net income. What's absolutely crazy, Melody, is the national payment to income ratio, again, and this is the point I'm making to the viewers, is higher than the global financial crisis. Right now, we're sitting at 35.3% national payment to income ratio. And that's if you put down 20%, and that's just your mortgage. When we also, again, look at net income, property taxes, homeowners insurance, this probably is more at 58%-ish. But nevertheless, just looking at only this chart, if we're going to be delusional, and we're just going to compare delusion to delusion, in the GFC, it was 33.9%. So from a payment, not talking about the over-leveraged price, we'll get to that, but just the payment is even worse than the global financial crisis, going back all the way to the mid-1980s. But I do have prices as well, and we're sitting at right now, and this is not even up to date, it's worse right now, 7.23 times your annual salary to be able to pay off a home. This chart is going back 50 years. Before the global financial crisis, we were sitting at about 3 to 4, primarily about 4. And before the whole lockdowns, we were at 5. So 5 years of your salary to pay your home off. You guys, this is absolutely skyrocketed. Put it in perspective, during the peak of the housing market bubble, during the global financial crisis, we didn't even break 7. So payments higher, prices higher, the whole economy is systemically over leveraged as a result of this. And look at this. Speaking of income, real, which is adjusted for inflation, real median household income is lower right now. And this is up into 2023. It's lower right now as it was compared to 2019. Adjusted for inflation, people were making more money in 2019. Looking at the early payment defaults, I wanted to point out this, Melody. Just because someone has a low interest rate doesn't mean they're okay. In fact, a lot of people with these low interest rates got blindsided by skyrocketing homeowners insurance, skyrocketing property taxes. I've been covering that a lot. And also, if you're on the east coast of Florida and own a condo, HOA assessments. But what I wanted to show you is the fiscal year cohort. Okay, it's interesting. It's saying that 2019 has the highest delinquency rate, sitting at a delinquency rate of 19.58%. Look at the interest rates. The interest rates in 2019, you guys, were in the 3s. Interest rates in the 3, just because you have a 3%, that doesn't mean you're okay. When we look at the big picture, which those data providers don't want you to do. All they want to do, you guys, is just change the law to keep this whole fraud going. What you're looking at here is a court document from the CFPB, which is basically stating they did an audit on a whole bunch of mortgages that were purchased from companies like Fannie Mae and Freddie Mac. And based on the 2018 data that they reviewed, the Bureau estimates that as a result of the general QM loans definition of 43% DTI limit, and by the way, you guys, they raised that. I believe it used to be 36%, Melody. So they already raised it. So it went from 36 to 43. Approximately 957,000 loans, or 16% of all loans originated in 2018, exceeded the qualified mortgage definition of affordable housing, 43% debt to income ratio. In other words, Melody, they just changed the law. They didn't make things easier and more safe for people. So question number one, can you explain to the viewers how specifically from the lending side, because you look at the behind the scenes stuff, how has gross negligence got us back to similar pattern of 2008 risks, whether it's leverage or qualification, lack of care, greed, corruption? Can you just explain that to the viewers?
Yeah, it's a little wild, Travis. I mean, I think what happened as I talked to my clients and other people who, as we now look at repurchase requests and early payment defaults, and we have to go back through these loans and relook at the underwriting, we can see that a lot of these loans were approved by the automated underwriting systems by the GSEs, Fannie, Freddie, when in reality they probably should not have been approved, and exceptions were accepted that probably should not have been accepted. But as my clients will tell you, if they don't make the mortgages that are approved, they could be accused of redlining, or so they themselves can't really underwrite these loans. They're relying on the products from the GSEs. And so it is just really disconcerting. I don't know whether this was completely on purpose, or, everybody just kept thinking because of all of that equity out there that it was okay. But this is precisely what happened last time. Everybody thought it was okay because there was an accelerating home price environment. And I remember the day when we stopped being able to say HPA, or home price appreciation. We had to start saying home price decline. And that was a day that was very hard for my executives to swallow, because everyone had said that home price appreciation would continue forever. And then everyone would be able to refi because they had so much equity. But as I started overlooking portfolios in late 2006, you just saw those loan to values erode. As prices came down, so did equity, and that loan to value didn't look so great anymore. Additionally, as borrowers came under stress, their credit scores started to deteriorate. And I've started to see, for the first time in my client portfolios, month over month decreases in aggregate credit scores. Now, when we actually get reporting for these student loans, that is going to increase materially as well.
Yeah, well said. And another thing also, Melody, and let me know whether or not you agree, another thing that led to risky loans is automated underwriting. So you don't even have a real person looking at loans now. You can push a button, you put the data in a system, automated underwriting. You can close on that loan as a lender, and then you can just sell that to Fannie Mae and Freddie Mac. I mean, if there's someone there to buy your bad paper and they're owned by the government, I mean, Fannie Mae and Freddie Mac, this is to my next question to you. That's arguably, and let me know if you agree on this as well, Fannie Mae and Freddie Mac is the government. I look at Fannie Mae and Freddie Mac as the long arm of the Federal Reserve, which I also look at as the government, and I look at the government as a bunch of bankers. There's been rumor that the new administration is going to deregulate Fannie Mae and Freddie Mac. Do you think the new administration will end reckless lending and reckless leveraging up on these assets like our homes?
I think the system will, not the administration. I mean, I think that because they have no incentive. I mean, those securitizations, that the GSEs do are, I mean, they're the lifeblood of the economy. And so there is no incentive to change anything. And people are still trying to get the last person in the door, the last bag holder. I mean, I get emails every day about more and more flexible programs, texts trying to give me crazy loans. So we're still in the part of the cycle where they're trying to bring in the last bag holder. So I don't see the administration making a change. Now, some of the things that are being talked about are very, very interesting, but I know how complicated and deep this all goes. And I think that people think this could be a easy, quick solution. That is that I don't believe that will happen. And if it does, it's going to be chaos in the markets, to be honest.
Well said. And Melody, I really got to give you a lot of respect. I like how you said the administration, it doesn't matter. The system will, because of how unaffordable and systemically leveraged up everything is. Is that right?
Correct. Yeah,
It's,
and let's not
that's
even talk about commercial real estate.
I was going to. I took it out. I took it out of the flow. I had it up. FHA does commercial real estate. I didn't realize.
Multifamily. Mhm.
Yeah, multifamily. But I want to move on. This is a perfect transition into the next segment of this video, which is the government messing around with the banks. And pretty much that's why we're in this situation. We've done nothing wrong. The inflation, the quantitative tightening, we don't deserve to lose our job for prices to get back to normal. We're basically paying for the mistakes of banks and from the mistakes of that greed, corruption, fraud in the Federal Reserve. And so what I want to do is I want to take it back to George Bush Jr.
Our system of free enterprise rests on the conviction that the federal government should interfere in the marketplace only when necessary. Given the precarious state of today's financial markets and their vital importance to the daily lives of the American people, government intervention is not only warranted, it is essential. In recent weeks, the federal government has taken a series of measures to help promote stability in the overall economy. To avoid severe disruptions in the financial markets and to support home financing, we took action to address the situation at Fannie Mae and Freddie Mac. The Federal Reserve also acted to prevent the disorderly liquidation of the insurance company AIG. And in coordination with central banks around the world, the Fed has injected much-needed liquidity into our financial system. These were targeted measures designed primarily to stop the problems of individual firms from spreading even more broadly. But more action is needed. We must address the root cause behind much of the instability in our markets. Mortgage assets that have lost value during the housing decline and are now restricting the flow of credit. America's economy is facing unprecedented challenges, and we are responding with unprecedented action.
He's talking about unprecedented actions. Melody, based on your expertise, first of all, I don't trust politicians. To me, especially what I know now, they're guilty until proven innocent, and they have not been proven innocent for quite some time. What do you think the root cause is? The problem that we have right now, unaffordability, no one could buy a house anymore, Melody. What's the root cause of that in your expertise opinion?
As my friend Rudy will often say, we privatize profits and we socialize losses. And that is, essentially we've had this, just unbelievably low rates, ZIRP, easy money, but easy money not for the hardworking Americans who go out just trying to feed their family every day, but easy money for the investor class, for the asset holders, which has created great wealth inequality, so that, we are living in a K-shaped economy where the lower group or cohort, which is about 80%, is miserable, while the top 10 to 20% is doing just fine. So, this government intervention, in my opinion, was not warranted. And had we just let the crisis play out, we would be much better off.
I 100% agree with you on that one, Melody. And They just kept doing it too after the global financial crisis. We've shown the viewers in 2012, the mortgage-backed security injection of hundreds of billions of dollars. That's you saw the behind the scenes of these Wall Street CEOs pocketing the taxpayer money, and and that was billions of dollars instead of that money going back to the victims, the homeowners. I mean, think of my situation. I lost my house. I was suffering for 10 years as a result because I had a bankruptcy for the foreclosure, the repo, tax lien. And I suffered for 10 years, and the bank that owned my house got bailed out, and they still got my house. How's that fair? They doubled up. Let's move on to our last video, Melody, about how Trump is talking about privatizing Fannie Mae and Freddie Mac.
To make investors feel that something is risk-free. Path one is Congress. Congress comes in, government creates an explicit guarantee. We tried that route, didn't happen. Unlikely to happen. The other route is, how do you build up these companies in such a way that the balance sheets are strong enough and the quality of the assets are strong enough that you get close to being risk-free?
Well, Calabria's plan was 8% capital on the balance sheet in front of the MBS and increased credit quality on borrowers. Now, the GSEs have been building considerable capital recently, although the pandemic cost them billions in bailouts for borrowers and mortgage services. I spoke with Mark Zandi, chief economist at Moody's, who said without an explicit government guarantee on the Fannie and Freddie MBS, mortgage rates would go up 75 to 100 basis points and even more for lower credit-worthy borrowers. He also argues that Trump just wants to boost the stock prices for wealthy shareholders like Bill Ackman. They're already way up since the election, but Calabria disagrees.
It's important to remember that at the end of the day, anything that happens to the shareholders is incidental. I don't believe anybody in this administration is looking to help them or hurt them.
But Calabria admits this will not be high on the president-elect's priority list. Zandi says the most likely scenario is that they stay in conservatorship. And he added, privatization is a solution looking for a problem.
It's interesting, Melody, how they say if they bring them private, it's going to create a problem. And it's probably because there's so much fraud. I mean, when I was listening to him talk, it makes me sick because he said, yeah, we just want an 8% capital requirement on their balance sheet. And to the viewers, what this is telling us as American citizens, this is a whole con. It's a shell game. There's no money. It's just all leverage. They can't even keep 8% of the loan on their balance sheet. So if they lend me $100,000, you guys, they don't even have $8,000 of that money. They lent me $100,000, but they don't even have $8,000 of that. Do y'all understand how ridiculous this whole thing is? And so I thought it was interesting, Melody. If they make Fannie and Freddie private, they're saying that interest rates will go up 75 to 100 basis points. If they make Fannie and Freddie private, the whole system comes crashing down, and probably rates will go down 200 basis points, 300 basis points. But my question to you, I mean, do you think Trump is going to bring them into the private sector? And do you think that Trump would let banks fail?
I honestly don't know, Travis. So it would be very difficult. Richard Whalen has floated a really good theory about how this would all work, and has made an argument that they're really seriously considering it, and they think that they could get some cash early on, and so they may try it again. This is a hornet's nest. It is so complicated. And I think a lot of people that are advocating for it don't actually understand the way all this works, nor do they understand that the non-banks who look like they're doing okay right now really aren't doing okay. They don't have deposits like the banks. And just remember that after the GFC and after the new Basel III requirements, the banks pulled back because they understand this government game. They understand this lending game. And they really didn't want a part of it. So the non-banks will be the ones who would shoulder this, and everybody, especially those who think private credit, private equity are just the greatest things in sliced bread, think that these non-banks will be able to handle it. They will not. They don't have the liquidity. And by the way, who gives them their loans? The banks. And so we're about to see, as as this crisis in Appalachia, the fires in LA, the aftermath of Beryl in Houston, we are seeing delinquency increase significantly now in 3 of the top 4 mortgage markets. That's California, Texas, Florida. What is that? It's going to be severe stress on the non-banks who do not have the liquidity to handle it, because they will be advancing out your payments when you're not making them. And then additionally, if those work out, so whenever you have a disaster like this, you go on a FEMA forbearance right away. There's different workouts you can do. You just heard her say about how much money the GSEs had to pay out during COVID. They will again be on the hook for that as well, which will also reduce their capital.
If I'm not mistaken, there's more debt with non-banks than real banks. And just for the viewers, a non-bank is just to get you guys an idea what that is, it's like an imaginary company. It's not really a bank. And it's really come into fruition after the global financial crisis, because it allows these companies, right, these non-banks, although they're doing everything like a bank except holding money, right? They're doing everything profit-wise. They're a middleman broker making fees. They're here and they've made them because of deregulation. And it gives the non-banks the ability to over leverage us.
Yeah, it's all combined. It's one big system, right? And that's why it's so difficult to really assign blame, because a lot of people operate in the system without having any idea what they're actually doing. But so few people understand the entire system. And I think so few people who are actually arguing for this into the conservatorship understand it, the mechanics and the players, because what they do is they listen to earnings calls where people just talk about the rosy stuff and not the charge-offs and not the repurchases. So, I just think that this may seem like an easy thing to do to the new administration, but it is a hornet's nest.
Absolutely. And Melody, just one more question, and then I want to show the viewers your Substack. Can you talk about how non-bank failure can actually lead to home price decline, and how that home price decline can actually lead to more foreclosures and short sales? Not the other way around, not foreclosures and then price decline. It's price decline and then foreclosures. And again, how the non-bank failure can start that snowball of nationwide price decline.
Well, with a non-bank failure, you're also going to have all kinds of job loss, and that itself is going to create stress on the system. But yeah, so as we were talking at the beginning of the show, the home price declines happen first, and then essentially you start to. So an important metric we haven't talked about yet is the Fed just told us that the highest amount of refinances were rejected since they started tracking in that series, meaning that people went to get credit, went to get a refinance in this not so great rate environment because they are under stress, and they were denied at the highest rates we've ever seen in tracking. And so ultimately, that's probably because they went and got an appraisal, which, they never made those repairs. They never, and also we know Fannie Mae has said likely 55% of appraisals out there were inflated. And so and then also their credit was probably dinged because of late payments on other bills and things like that, or they simply just did not have the income with increased taxes and insurance. And so as prices go down, you have less of that equity to bargain with the servicer. And it just becomes, kind of dominoes from there.
I was not honest. I do have one more question, and I'm going to...
Not honest.
Well, I said I only had one more question, then I was going to throw up your Substack. Okay. But, and this is kind of more of a fun question, it's speculating, but how many more years do you think we're going to have to wait before it might be a good idea for the average Joe to go buy a house?
It just depends on what they're trying to achieve. If they want to live in the house for the next 20 years, that honestly, in some areas, could be late next year. But that's taking a lot of homework, being aggressive in negotiations. doing your research. But ultimately, I don't think we see prices bottom for several years. And there's a lot of things that could accelerate this or decelerate it. Right now, with what's happening here in Appalachia and out in LA, we're looking at acceleration right now for those declines in home prices. So, and I know that's probably shocking for people to hear because they think, well, there's going to be more construction, there's going to be more people needing rental. But as you and I know, Travis, so few people had the right coverage and they're not able to cover new rental expenses. And a lot of people are living with friends and family.
I mean, yeah, and the city is broke. They don't even have enough money to have enough water to continue to fight that fire. And that's a really nice area. So, well said. I mean, I see the same thing, multiple years of home price decline. And whether or not someone should buy right now, it depends a lot on goals. But as far as overall affordability, years, 2, 3 years, something like that. And real quick for the viewers, if you liked what Melody Wright had to say, here is her Substack. Just type in Google Melody Wright Substack. Come here, subscribe. You don't have to pay for it if you don't want, but if you do, it would surely be helping out a great person in Melody Wright. Some really, really good data here. And Melody, we really appreciate your time, your expertise, everything that you've given back to the viewers. Thank you so much. Hopefully we'll get DNN up and running here soon, but I wanted to leave you with final words to the viewers.
Yeah, just thank you for having me, Travis. This is a really, I'll say it, perilous time. There's a lot going on, and a lot of us just wanted the election to be over with. But I think in these very first days of 2025, we see that nothing is slowing down. So it is the time to stay frosty, is what I often say, meaning we have to pay attention to the mile markers and what's happening. The path is very clear to me, but there are things that can accelerate it or decelerate it, as I said. And so it's really important to be paying attention to shows like yours, to my Substack for what's happening, because things can change very quickly. Like, for instance, these fires in LA, I think, are going to have a very detrimental effect on the overall housing market.
Yeah, it absolutely will. And so not using your emotions, but rather using math is probably a smart way to purchase real estate. Melody, I thank you for your time. And to the viewers, thank you for following along and paying attention to this video. Don't forget, like it, comment below, share it. And if you guys are out there investing in real estate, investing in life, just trying to live, you guys already know that we wish you luck and we hope you win.